Before we get into it, nothing here is financial advice, just my opinion. 1.86 billion in free cash flow. The stock down 51%, not because the business broke, because one government contract changed hands. The filings tell a different story than the price. Let us find out what is actually true. And if this was useful, go ahead and like the video. It helps the channel grow. Leidos is one of the largest pure-play government technology contractors in the country. 50,000 employees building and running the digital backbone for the Department of War, the U.S. intelligence community, Homeland Security, and the federal health system. They don't make headlines like defense primes building jets or ships. They make money running the software, the cloud infrastructure, and the IT systems that keep those bigger programs functioning. Most people don't realize this is the company behind the electronic health record system used across the entire U.S. military health system. A fact that matters a lot for what we're about to cover. Here's the chart. Leidos peaked at just over $200 in early January. From there, it fell in 3 distinct waves: an initial breakdown in February, a failed bounce in March, and then an accelerated slide through May and June as analyst downgrades piled up. This isn't a single bad headline causing a one-day gap down. This is a 6-month grind, and as of the most recent close, the stock is sitting right at its 52-week low. The question isn't whether the market got spooked. It clearly did. The question is whether the fear matches the actual business risk or whether it's overshot it. Let's walk the actual numbers. Straight from the 10Q, not a stock screener. 17.3 billion in trailing revenue, 1.4 billion in net income. But I don't care about net income. I care about owner earnings. That's free cash flow minus stock-based compensation. Because stock-based compensation is real dilution, a real cost to you as a shareholder, even though it doesn't show up as a cash expense. Leidos generated $1.76 billion in owner earnings over the last 12 months. At today's enterprise value, that's about 10.5 times owner earnings. For a company that just put up 4% revenue growth and is still winning billion-dollar contracts, that's a cheap multiple. This is where the story gets complicated, not broken, complicated. Leidos closed a $2.4 billion acquisition in late March called EN Trust, funded mostly with new debt. That took total debt to $6.3 billion and pushed debt to equity to 1.26 times. That's elevated, not alarming. Interest coverage still sits at roughly 9 times operating income, so the debt is serviceable. What does look strange if you don't know the context is tangible book value? It's actually negative $4.1 billion. That sounds scary, but it's just goodwill from years of acquisitions. It's normal for an asset-light services company like this one. It adds fragility, but it is not a solvency problem. The honest version of this story: net income has drifted down slightly over the last 4 quarters. 391, 367, 327, $328 million. That's not a collapse, but it's not acceleration either. Revenue is still growing, just modestly, about 4% year over year in the most recent quarter. The real test of whether this trend is a problem or just noise is what happens to the health segment specifically, given what's coming in the next slide. On this channel, we don't name super investors we can't confirm. That's not our standard. But here's what is confirmed, straight from SEC Form 4 filings. The CEO of this company, Thomas Bell, bought 1,700 shares on the open market at $145, August 2024. His own money, not a stock grant, not an option exercise, a purchase. 2 months later, Director Noel Gear bought 2,000 shares at $161, November 2024. Both of those men paid more for this stock than you can pay for it right now. That doesn't make it a buy. What it tells you is that the people sitting in the boardroom, reading every contract win and every contract risk before you do, they were willing to put their personal capital on the line at prices significantly higher than today's. The analyst community agrees. 13 firms cover this stock. 5 say buy, 8 say hold, 0 say sell. And that's after 2 downgrades in June. The average price target still implies 60 to 80% upside from where we are right now. The street is cautious. The insiders were convicted. Neither of those things guarantees anything, but both of them are worth knowing. For valuation on this channel, I use one number, EEV divided by owner earnings. That's enterprise value divided by free cash flow minus stock-based compensation. No DCF, no PE, no made-up assumptions. Today, Leidos trades at 10.5 times owner earnings. That puts it below our bear case scenario of 15 times, which would give a valuation of $163 per share. Our base case at 20 times values the business at $233 per share. And our bull case at 30 times, assuming the health segment overhang resolves, takes it to 373. Every scenario, bear, base, and bull, implies the stock is undervalued at today's price. The only question is how much risk you assign to the health segment transition. Reason 1, deep value on real cash flow. 10.5 times owner earnings is a multiple you'd expect from a company in secular decline. Leidos is growing revenue, not shrinking. That gap between the multiple and the growth rate is the entire bull case in one sentence. Reason 2, the cash machine keeps running. $1.86 billion in free cash flow over the trailing year on CapEx of just $134 million. This is an asset-light services business. Most of what it earns converts to cash you can actually use, whether that's debt paydown, buybacks, or dividends. Reason 3, the street hasn't given up. 13 analysts, 0 sell ratings, even after 2 firms cut their price targets hard. Average target still 60+% above today's price. Wall Street is recalibrating for risk, not abandoning the thesis. The bull says, this is a cash-generative government prime trading like a company that's losing when it's actually still growing. Just facing one real identifiable headwind. Risk 1, the health segment. Headwind is real and dated. This isn't speculation. The Defense Health Agency filed a formal notice moving away from Leidos as lead systems integrator for the military's electronic health record system. Philips and Amwell transition off by the end of July, Oracle Health by November, the rest by next July. Health segment work is roughly a quarter of total revenue. We don't yet know exactly how much of that segment's revenue is tied to this specific role, and neither does the market, which is part of why the stock is this volatile. Risk 2, they took on real leverage at a bad time. Total debt jumped from $4.6 billion to $6.3 billion in a single quarter to fund the EN Trust acquisition, right as the stock itself was falling. Debt to equity at 1.26 times is manageable, but it removes flexibility if the health segment situation gets worse before it gets better. Risk 3, the chart hasn't confirmed a bottom. Price is below the 10-day, 50-day, and 200-day moving averages. Momentum indicators are still pointed down with no reversal signal. Cheap can get cheaper, and right now there's no technical evidence the selling is finished. The bear says, a real dated contract loss is hitting a company that just leveraged up, and the chart agrees there's no confirmed bottom yet. Dollars inflate, gold does not. At today's price of $99.79, one share of Leidos costs you 0.0248 ounces of gold. The math, $99.79 divided by 4,034 equals 0.0248 ounces. At the January all-time high of $203.77, that same share cost 0.0452 ounces when gold was $4,510. The stock has repriced from 0.0452 down to 0.0248 ounces in real terms, a loss of about 45% of purchasing power. We track this again in January 2027. Dollars and gold ounces, both. Here is where I stop guessing and start measuring. Valuation passes. This is cheap on owner earnings. The balance sheet is a watch item, not a red flag, after the debt-funded acquisition. Margins are holding up fine. Growth carries a real watch flag because of the health segment situation. Smart money passes. The analyst consensus is still net positive with 0 sell ratings, and insider buying above today's price is worth noting. And risk gets a fail, honestly, because the DHA contract loss is confirmed and dated, not speculative. My own position, I'm watching, not buying yet. What would change my mind to buy? Clarity on the dollar impact of the MHS Genesis transition at the second quarter earnings in early August. What would change my mind to walk away entirely? Any sign the health segment problem is spreading into other segments, or a confirmed breakdown below the 52-week low on heavy volume. We track this in gold ounces and revisit it in 6 months. That is the Leidos thesis. I will track this every month in the portfolio scorecard, dollars and gold ounces, so you can judge the thesis as it plays out. If you want to follow along, subscribe and hit the bell. Every episode, one stock, one honest scorecard. We show you the data, you make the call. This is the Think Tank Trader, not financial advice, just a self-taught investor sharing the process. See you next episode.